Good morning, everyone, and welcome to our live session on principles of transfer pricing. Uh, my name is Garg. I am a chartered accountant and practicing in the area of transfer pricing for almost 14 years. So uh, I deal with a lot of transfer pricing issues. Through these video lectures, I'm going to share what I've learned in transfer pricing. And today is the first class on principles of transfer pricing. I'm sure that my lectures would going to assist you in building conceptual clarities when it comes to transfer pricing. Uh, so if you have any query in this session, you can ask me via chat box, or you can also send me WhatsApp after the session if there is some query related to the topic that we're going to discuss today. You can share your query on my WhatsApp number, which is 9899994934. And if you are from outside India, you do add my country code, which is +91. So it comes +919899994934. So now, do remember, as we generally say, to kindly like this session and do press the bell icon, because if tomorrow I come up again on transfer pricing, or whenever I will come up again on transfer pricing, video on transfer pricing or related topic, you will get notification that yes, Gaurav is live or Gaurav has uploaded some video on transfer pricing. Now, starting with my session, but before that, today is very important day in India. It's a very spiritual day. We call it Guru Purnima, wherein the significance or the respect is given to gurus. Guru is a person who guides you, who gives you a direction when there is when you are confused, and that direction relates to your life. It assists you in achieving higher goal. So first of all, I must do pranam to all the gurus who supported me and who are supporting the humanity in building peace and love. Thank you. Now let's start our session. So this term transfer pricing, or let's say transfer price. What do you mean by these two terms when I say transfer price or transfer pricing? So transfer price, is a price for transfer. That's why we're calling it transfer price. But when we call it transfer pricing, it is a exercise. It is a exercise to determine price for a transfer. Correct? So these are two terms. One is transfer price, and second is transfer pricing. So transfer pricing is an exercise or a methodology to compute price when there is a transfer. Transfer of goods, transfer of services, transfer of intangibles, or anything which can be transferred from one point to another point, from one entity to another entity, from one enterprise to another enterprise, from one related party to another related party, from one person to another person. When you can transfer something, the exercise to compute price of the same is known as transfer pricing. The price used in the transaction for transfer of goods or services or intangibles or tangibles, whatever, is called transfer price. So, is it something new to you? Since beginning, I feel since childhood, we guys are involved in doing transfer pricing. Hey, don't laugh, don't laugh. Why I'm saying you guys are involved in doing transfer pricing is because since childhood, we keep on evaluating what should be the price. Let's say even a kid, if there is an option whether you want to buy a chocolate or you want a lunch box, he would evaluate in his mind, whether I should buy a chocolate or I should buy a lunch box. So there is an option. He is doing some computation in his mind. So when it comes to law has got certain methodology. But when it comes to open market, in our day-to-day routine, whether you went to go and buy vegetables or a good shirt for you or a trouser for you or a good pen or a laptop or camera or mobile, some exercise. You try to justify the price in your mind, that you're buying a good product at a good price and not a higher price. So we do such kind of computation in our mindset within us, and this is what transcribing is. But when it comes to law, when it comes to tax law, there is certain methodology, there is certain scheme which we need to follow. So in income tax law, generally, when it comes to when two tax experts speaks or two professionals speaks about transfer pricing, they mean transfer pricing from tax purposes. So when we talk about transfer pricing for tax purposes, there is a scheme, there is a pattern, there is a methodology which a person needs to follow while transferring goods from one enterprise to another enterprise. Now, why we need transfer pricing? Why we need transfer pricing in tax law? That is the big question. In general, if you see, the relationship to impact prices. For example, let's say someone senior in your family is a doctor, and you're not feeling well, so you visit your family member, or you visit the doctor who is a very close relative to you. Does he going to charge the price? As far as India is concerned, I think answer is not, and most probably in many of the cases the answer is zero. If you are visiting to your brother or to your father who is a medical practitioner and who is going to check whether whether there is some illness or not, probably they may not charge any price, which means relationships to impact pricing. So the impact is because of tax or because of any other reason is something which matters. But when it comes to tax, it does not matter. So what matters is if there is a transaction between two related parties and to associated enterprises, then the price between a price used for the transaction should be justified. That is, the transfer price for that transaction between two associated enterprises must be justified. So law assumes, or the tax authority assumes, if there is a transaction between two associated enterprises, they might have done pricing in such a manner which may not give them fair share of tax. So what they say, keep your relationship up to you. It hardly matters to us. What matters to us, what I'm getting as a tax authority, what I'm getting is the fair share of tax or not. So the lot of studies were conducted by various authorities, and it was found, and my practical experience also say that the multinational enterprises they do try to use transfer price for manipulating the profits in one jurisdiction. So what they do, will take up a common example. Let's say there are three entities. One entity is in India, and then another entity is in Europe, and there is one entity in UAE. India wants to, from India, I want to export goods to Europe, and I'm sure that I'm going to get €100 per unit for this product in Europe. But the costing in India, let's say, comes to €40. So I need to book profits of €60 in India. So what I will do, I will open a company in UAE, and that UAE company will going to purchase goods from me and then export it to Europe. By doing this, I'm going to park certain profit in UAE. So let's say I'm a so by doing this, tax jurisdiction is having low tax. So this can be done, and many multinational enterprises do try to do that. And, they do try to do that. Certainly, at this point in time, it is important to understand that, or important to keep in mind, that BEPS rule, OECD has come up with the base erosion and profit shifting action points, and one of the action point number 5, it's kind of assisting tax authorities uh, in avoiding, in stopping such kind of transactions. I am, getting few questions, so I will come. There's one question from Gaurav which says, "Hello, sir. This lecture is for practical scenario or theoretical?" I think both. You need to be good in both theory and practical. So what I'm saying is coming out of the practical, exposure. But yes, theory and practical both are important. Will you apply to branch transfer also? Sarthak, I think you need to wait. We are on the first leg of our video. So I will come up to your, will reply to your question, maybe in this video or maybe in another video. Now, the tax authority wants to check such malpractices, and they bring transfer pricing law in their tax laws. Uh, Now we have OECD, Organization for Economic and Cooperation Development. OECD, we have, there's a Model Tax Convention, there is Article 9 in OECD, and OECD has also come up with transfer pricing guidelines. So how it works, each country is free to come up with their own transfer pricing law. But if they will going to come up with their own transfer pricing law, it will going to create chaos. So there is a kind of agreement that yes, we're going to follow certain international norms, international standards when it comes to transfer pricing. So there is less chaos and more discipline, and more importantly, the business survives. There should not be double taxation. It should not happen that I'm taxing the same profits in India and the same profits are getting taxed in other tax jurisdictions. So we have OECD to take care of this. We have UN to take care of this, and there are various conventions. We have OECD Model Tax Convention. We have UN Model Tax Convention. So I will focus on Article 9. I will focus on OECD Model Tax Convention because I personally believe, OECD, when it comes to TP, transfer pricing guidelines of OECD is the Bible, and very important document for every transfer pricing consultant to go through, to have it on its desk. Now, if we go to Article 9, so what Article 9 of OECD Model Tax Convention says, and what is the importance of Article 9, double taxation. So by economic double taxation, we mean, let's take an example. Let's say there's country A and country B. Now the company in country A transfers goods to company B in country B for $100. Now the country A says instead of $100, you should have supply for $120, which means they will inflate the income in country A by $20, whereas in country B the expenditure is still $100. So that $20 will get doubly taxed. Or if we do it on a reverse side, let's say now country B says instead of $100 you should have bought it for $80. So country B will allow expenditure only of $80 and will going to charge tax on this excess amount, the difference, $20. Whereas in country A, still the income is $100. So country A will going to charge again that the complete tax on $100, which means $20 is getting taxed twice. Once in the hand of company B and once in the hand of company A. This is called economic double taxation. So in order to avoid economic double taxation, we have Article 9. which is applicable on transaction between associated enterprises. Uh, so it starts with basically, it confirms the right of contracting state to apply price provisions. It avoids, it tries to avoid the economic double taxation, and it defines associated enterprises very broadly. So I'm going through para 1. It says, where an enterprise of a contracting state participates directly or indirectly in the management, control, or capital of an enterprise of the other contracting state. In simple language, if there are two companies, company A and company B, and if company A participates directly or indirectly in company B in the management, control, or capital of company B, so company A participates directly or indirectly in the management, control, or capital of company B, it would be regarded as associated enterprise. But Article 9 does not define what is management, what is control, what is capital, and thus it gives a very broad perspective. Now, each country, is within its ambit to define or to come up with more clear relationships, which falls under this category, that is management, control, or capital. In India, we have Section 92A, which gives the meaning of associated enterprise. So we have certain, criteria. If you fulfill any